Hey everyone, I'm really excited to host Bitstamp's first Fireside chat. It is an absolute pleasure to introduce Charlie Morris, co-founder and chief investment officer at ByteTree's. Charlie has over 20 years experience in active portfolio management and specializes in alternative assets like gold and Bitcoin. He is also the co-author of ByteTree's Bitcoin Value Drivers report that we'll be discussing today. Charlie, welcome to the show.
Thank you. Lovely to be here.
All right. So, are you warming up for the second wave of lockdowns in the UK?
Oh, the lockdown. My gosh. 2020. What a year to write off. You know, you've got to wonder what people will say in 10 years' time when they look back. Will they laugh at our behavior, or will they say that was the beginning of something terrible? I mean, who knows where it will take us? But, you know, right now, the way I'm thinking is that it will be a chapter in the madness of crowds in the future.
I agree. We are living in a world unimaginable almost a year ago, and we're facing the second wave of pandemics, equity market all-time highs, growing unemployment, and historic, if not even epic fiscal stimulus. So going to the report, how do you see this impacting Bitcoin, and where does Bitcoin fit in your...
Well, yeah, I think we've always been on the lookout for alternative assets. Alternative assets have always had appeal because they add to diversification. You know, and if you could find, and they say a diversified portfolio has, 8 to 12 investments, you don't need many more than that to achieve most of your aims in diversification. If you could find 8 to 12 things that were genuinely different, then the job would be done. But unfortunately, everything has become correlated, and prices have been inflated by money printing and stimulus over many, many years. And so actually trying to have uncorrelated assets is a very, very difficult thing to achieve. Of course, you can buy derivatives which do different things, but they come at a cost, generally speaking. And paying for investments isn't really the point. You really want to be earning money from earning investments. And so Bitcoin, comes along, and it's very much in the idea of the 21st century. It embraces computing. The internet keeps going forward and doing amazing new things. And you kind of sit back. Any critics of Bitcoin, I'd say to them, but surely the internet, has a go at everything, and it would come to assets and so forth at some point, wouldn't it? And this is how it is. You might not like how it looks, how it smells, but this is what it is. This is the offering, and it's caught on. I mean, there's a huge amount of activity in this space, and every year it grows, and there's more on offer. It grows up. There's more security. There's more credibility. There's more utility. So what's not to like?
Yeah, I absolutely agree. But it may sound obvious sometimes, but you describe Bitcoin as a risk-on asset, and that it's more closely correlated to risky assets as opposed to gold. So can you share some of the insights of your findings?
Yes. Well, let's define that. I mean, there's two things. Firstly, there's the market. So, I don't know many assets that go up when the market goes down. And I mean, there really are few. I mean, the long bond historically, but basically that's because the market's gone down for deflationary reasons. Had the market gone down for inflationary reasons, and the long bond wouldn't be very happy at all. So you got to pick your market and your time period. But basically, most assets go down when there's bad news, and I think Bitcoin is no exception to that. Now, we then talk about the relative performance, or the alpha rather than the beta. And does something outperform when the market goes down, or does it underperform? And something like gold outperforms when the market goes down. And we saw that in every single market correction we've had in recent years. Gold has gone down, but far less than the market during a period of shock. And in the case of Bitcoin, I would say every time it's gone down pretty much more than the market. It certainly did that in the period of COVID. And other corrections. And it hasn't been heavily tested really in macro conditions, because it came after the credit crisis in 2008. Obviously, it was born in 2009, and there wasn't a price until 2010. So we don't actually know much about the macro, but the little we do know is it doesn't like it. It doesn't like a shock. It behaves very much like a tech stock under such conditions.
And that's interesting, since it was born out of this shock of 2008, and the narrative we always had since the inception of Bitcoin is that it pretty much is the hedge against this economic downturn. So right now we're probably living in a world again where everyone is expecting a big downturn. No one actually knows when it's going to happen or how it's going to look like, obviously. But what do you think will happen when the music stops and the global equity markets take a downturn? What does Bitcoin do? And maybe when does it decouple from this correlation that we just covered?
Well, I think the answer to that is inflation. I touched on it. I mean, but going back to the 1970s, gold did extremely well. It was up roughly 27 times over the decade, when most assets, generally speaking, shares and bonds in real terms, went down by more than 50% over a 10-year period, including dividends. So, you got wiped out in traditional assets in a time when gold did extremely well. I think in that sense, Bitcoin could easily take that role, because the difference between gold and Bitcoin on a valuation perspective is that, gold is already well distributed, and it's adopted by central banks, and it's heavily utilized by investors. I'm a huge fan of gold, by the way. I don't see it as competition. Whereas Bitcoin has that ahead of it. And so I think from that simple point, there's a lot more to be done in Bitcoin. But the point is that when the stock market goes down, you have to ask why it went down. And in a deflationary shock, that's when people stop investing and they have a flight to cash. They sell everything they own. Yeah. And that doesn't matter what it is, whether it's Bitcoin, gold, or shares. And so that's always going to be a problem. But the decouple becomes if there's a lack of confidence in the financial system, and that would mean some kind of inflation. And so the value of fiat currency goes down, and under such circumstances, then the price of Bitcoin and indeed the price of gold would go up, just like they did in 1973, which was the last time that idea was really tested.
Yeah, and it's a very interesting thing to brought up. So, do you recall what were the interest rates in the end of 1970s?
I think the 10-year yield was around 10%, but I think the overnights were about 15.
What a time to be alive! So that's probably good. Yeah.
High interest rates have their advantages, because it was very cheap to buy a house at that time.
Yeah, for sure. But we're already going into a territory that most Bitcoiners avoid. I mean, real rates, interest rates. Can you share some of your thoughts also on gold and Bitcoin versus real rates in general? I know you touched on it in your report, and this is probably the territory that most Bitcoiners never, ever venture into.
Right. So let me give an example. It's pretty obvious, and the report has a good chart on this. If we take the stimulus and measure it by, it's one of many measures, but a popular measure is, how big are central bank balance sheets, because ultimately that captures everything. How much money is coming to the system must somehow register there. And pretty much all assets correlate with that somehow or another, because more money comes to the system and asset prices go up. But the nuance is that real interest rates don't treat everything in quite the same way. Some assets don't really care what real interest rates are. Other assets are highly sensitive to them. And gold basically really likes them, because if you think about it, why would you buy gold when the bank was giving you 10% interest and inflation was very low? I mean, that's very attractive. And obviously that doesn't happen, but it's an example. And if you turn that into a reverse and you had no interest from the bank, but you had high inflation, there'd be no incentive to be in the bank, and there'll be an incentive to own something that had a long-term store of value. And so it's kind of not surprising that there are most scenarios are in between those, and the fair value of gold sits alongside that. Now in Bitcoin, it's really it's a very different case, because it's a growth asset, and growth stocks tend to like rising real interest rates. Now it could be that one day Bitcoin changes its spots, but I'm just telling you how it's behaved over the last 10 years. And a growth stock, it's something like a Microsoft or an Amazon. The idea is they're going to make lots and lots of money in 10 years' time, right? Even more than they do today. And so the stock market gets very excited in that. Now, if real interest rates are very high, then that tells us that the dollar is going to be very, very valuable in the future. So we love the dollar today, and we're going to love it in the future as well. And so if a company comes along and says, not only are we making lots of money today, but we're going to make even more in the future, you go, wow, you're going to make lots of money in a great currency in the future. Well, that's really valuable. Yeah. And that's what the market has been doing really in recent years. Now, the FANGs are slightly different, but and the example of that is in 1999, we had quite high real interest rates, and growth stocks were the highest valuation that they've been in many, many years, since the late 60s. Now, in the last 2 decades, we've had falling real interest rates, which has been very strong for gold. Now, we've had a tech bubble for other reasons, yeah? But the point is that a rising real interest rate rewards a growth stock much more so than it rewards gold, because you've got this idea that in the long term, you're going to do very, very well. Now, Bitcoin isn't quite a growth stock. It kind of has been in the last few years because it's been aligned with social media stocks, and the correlation has been very high. And the evidence for that really is something like 2014, when the stock market, the price of Bitcoin collapsed, and also 2018, the price of Bitcoin collapsed. And in those same years, tech stocks did very badly. Social media stocks, internet stocks did very badly. And in the other years, like 2013 and 17, tech stocks, social media stocks did extremely well. So you have this pretty conclusive, beyond coincidence link between them. Now, so I'm being a bit long-winded here, but what we really are trying to do is say, well, when will Bitcoin morph from behaving like a tech stock, when it's in its growth phase, which it is right now, and start becoming something that's a bit more inflation sensitive and a bit more tangible and a bit more like hard money, yeah? And I think that really is the big macro prediction, because certainly if you look at the last few years, 95% of Bitcoin's gains have come when the economy's been risk on, when the bond yield's been rising, and when the inflation expectations have been rising. Yeah, and so there's no doubt about it that Bitcoin is firmly risk on. It likes inflation. It likes a rising bond yield. Doesn't like what's happening in debt deflation at all. And if we let go and had a 2008 or 2015, or indeed another COVID, it would go down. But the point is, you've got a slightly different dynamic to what's happening in gold. And my final point, I want to illustrate that with what happened in 2013. Real interest rates went up in 2013 as the Federal Reserve were expected to start hiking rates. What happened? Well, Bitcoin, as I just said, had one of its best years on record, or its best year on record, 2013. And gold had its worst year since 1988. So you kind of think, well, the evidence out there is that Bitcoin likes rising real rates, and gold likes falling real rates. And my final point is that if you rebalance a portfolio between gold and Bitcoin, you have a better Sharpe ratio than if you hold either alone, which tells you there are diversification benefits, which tells you they're uncorrelated, or at least lowly correlated.
And
I waffled.
Yeah, so in short, Bitcoin and gold are the exact opposites.
Not the exact opposites, but yes, they have a lot of opposite characteristics. Yeah.
But put together in a portfolio, how do you see that playing out?
What, if you put both of them into a portfolio?
Yes.
Oh, I think that a portfolio with gold is better than one without. A portfolio with Bitcoin is better than one without. And a portfolio that with both is definitely better than all three other alternatives. So if you're a fan of alternative assets, then those with liquidity and low correlation make a lot of sense. See, when people talk about alternative assets, most people choose, come up with crazy ideas and come up with things that are illiquid. Yeah. So of course you can put art into a portfolio, or you can put stamps in and all this stuff, or a grand piano, or music rights. But this stuff is illiquid. It's very easy to find uncorrelated illiquid assets. It's very hard to find uncorrelated liquid assets. And that's the beauty of these sort of alternatives. And the criticism always from traditional finance is you can't value them because they haven't got cash flows. Well, maybe the fact they haven't got cash flows is actually the point here, because what they're hedging against is cash being trash.
Isn't that what Ray Dalio recently said in one of his interviews, that cash is trash?
Yes, I'm sure he didn't invent the phrase. It was around a long time before him. But I admire Ray Dalio. I mean, he's written some good works recently.
Yeah.
He's not a fan of Bitcoin, though, is he?
No, not that I recall. Some of his friends already are, it seems, but not Ray Dalio.
But I can see, he manages really large portfolios, and I don't know what his AUM is, but it must be 100 billion plus. It's probably a lot more than that. And so, Bitcoin just doesn't even register as a possibility for a firm like that. So maybe when it's a lot much larger, then it's the sort of thing that they would consider. But I would think that they're probably not particularly. They're very expert in using traditional assets and putting them together very, very cleverly. And I would think that if Bitcoin was much larger, then it might be on their radar.
For sure, liquidity. Well, liquidity is pretty much key. And speaking of liquidity and alternative assets, so we've all known this narrative that's been around Bitcoin ever since its inception, that it's digital gold. And you spent the better part of your career in gold and on markets. And one interesting part that I've seen in the report was the way you describe the market cycles, depression, expansion, boom, and stagflation, and how Bitcoin fits into these, opposed to cash and gold. Could you share some of your findings here?
Yes, I mean, as I say, gold likes falling real interest rates. So the perfect scenario for gold is lots of inflation, which kind of means the denominator. When we talk about what is gold worth, well, gold per dollar, ounces per dollar. And so if the denominator, the dollar, is going down, then obviously the gold is going up. So inflation, very simply, is attractive not just for gold, but for most assets where their final value is not actually in the underlying currency itself. And but it also likes a kind of risk-off conditions for relative performance terms. So it wants easy money. So gold's perfect environment is easy money and high inflation. And its worst environment is the opposite of that. But if we think, but there's a scenario for every single asset. And my analogy really is water. Now, if you imagine water is money, and I haven't told this story for a while, so I'll try and remember it. But essentially, when money is frozen, then that means that water is not going anywhere, right? There's no evaporation, and this is what we have in a credit crisis. Yeah. So you have all this frozen water, money is locked up, and it can't do anything. Yeah. And nothing is growing. It's not a nice place to live. It's not a place to be. But as you warm the temperature up, you kind of go into a growth environment. So you've now got running water. It's a clean running water. Everything's growing. Everyone's happy. A very sort of temperate climate. And then as you continue to warm up, you sort of get to a jungle environment where you get a steamy place, and you get lots and lots of crazy species. You're now in the Amazon jungle or something. But there's also lots of disease, and it's a dangerous place to be. And this is when inflation starts to come, because you've got the water, lots of steam, and all the water goes into the atmosphere. And then if you turn the temperature up again of the water, you end up in the desert, and all the money is gone, and there's lots and lots of inflation because any water that comes is evaporated away. And so those are the kind of scenarios I was talking about. And so the frozen water is very much the quality environment. That's when you have the depression. And then when you start to pick up and you start to have the growth environment, that's the sort of temperate. And then the sort of the value, the stagflation environment is very much the jungle. And then the desert is when you want to own gold. And so you put all those scenarios together, and you kind of realize that actually it all comes down to how money is behaving. Yeah. And so my analogy with water, you might find it slightly laughable, but it kind of worked for me when I was writing a magazine article a few years ago, and it sort of makes sense, because if there's no faith in the money, then there's no faith in the system, and there's no investment and all the rest of it. Or if the money is locked up, then it can't be used, and what have you. And so that's why central bankers are always trying to get the whole thing into sort of Goldilocks, where it's just right. You've got the money flowing around the system, but without the excess of inflation. So those are the sort of four quadrants I talk about. And basically, it's pretty simple. Gold likes risk off. Bitcoin likes risk on. Both of them are inflation sensitive.
Yeah. And one very interesting proxy that you've also mentioned as well for the kind of the macro view, not just for, the general macro indicator for the health of the ecosystem, or should I say the economy, is also the bond market. Now, everyone enjoys equities because they're sexy, they make great headlines, people like to talk about Bitcoin, but smart investors that I've ever spoken with tend to listen to the bond market. And we've touched on the subject a few times in our previous kind of chats. Can you share some lights on how Bitcoin reacts to dynamics in the bond market?
Yes, well, the bond market is, I mean, it's a very good point. The bond yield has been coming down and down and down, right? And the remarkable thing is that Bitcoin has doubled 17 times. Yeah, now if you think that's nothing, it's think about it again. 17 doubles is pretty record-breaking stuff. And it's done that over the last decade, essentially when the bond yield has been coming down. Yet if you look at that a bit more closely, you'll realize that most of Bitcoin's gain, the vast majority of Bitcoin's gain, came during times when the bond yield was going up. So when the economy was expanding, so when people were taking risk. Yeah. So it's remarkable that you've had an asset that I would make a strong case to say it prefers rising yield to falling yield alongside most risky assets, and yet it's done all that gain. And it would probably transpire as well that most of Bitcoin's gain would come when corporate bonds were doing well, perhaps even when emerging market bonds were doing well, funnily enough, despite the narrative that Bitcoin does well when Venezuela or Turkey is in trouble. I mean, yes, that's true. I mean, it does work better in those countries, but it doesn't affect people in America or Europe don't buy it because there's a problem in Venezuela, which is obviously the majority of the volume. That I would say is one interesting use case, a positive use case for Bitcoin around the world. But generally speaking, it just tends to be risk off. And the reason the bond market is so important is because it's always the lead in these things. It's a big liquid market. And there's always been a sort of joke that it's the wise one and the stock market is the sort of naughty teenager, the teenager that sort of catches up and makes all these stupid mistakes along the way. I mean, but the classic example was 2007, where the US or even Europe too, the 2-year bond yield was just going down and down and down and down. A long time before anyone in the equity market woke up recognizing there's a problem. So if you want to know, is there a problem in the world? Well, where's the 2-year? Well, it's on the floor.
Yeah, great. Now, maybe changing the topic a little bit from a more macro global view to a more, I would say, crypto-specific, Bitcoin-specific. So one of the things that I found really interesting in your report, and something that subconsciously I always kind of agreed with, but never could really put a finger on it, was the stock to flow thesis and how it plays out. And I think this one will really ruffle some Bitcoiner feathers. So can you share what's your take on the stock to flow theory in Bitcoin, supply and demand?
Well, stock to flow, let's face it, if you have 1% inflation, you have a stock to flow of 100. If you have 100% inflation, you have a stock to flow of 1. Yeah. So it's just a kind of inflation inverted. And so I do think that because it sounds good, stock to flow, it sounds cool and exciting, and it's what you'd have. If you had a Ferrari, where's the stock to flow, and you wouldn't talk about where's the inflation. So I think that sort of sexed up something really boring. So let's start with the point that stock to flow is nothing more than asset inflation. Okay, so stock flow of 100 means that next year the number of Bitcoins will increase by 1%. Right? Are you asleep yet? I mean, you should be asleep on that comment, right?
I was slightly dozing off, but now you got my attention again.
Right. So it's the most incredibly boring piece of information, sexed up. So I think that's important to make that point. And then there are other things like, for example, all great asset classes have high stock to flow ratios. Well, of course they do. Of course they do, because all the great asset classes, from gold to real estate to whatever. Well, firstly, they're big, right? So the stock to flow is on a X and Y axis, and sorry, the Y axis is kind of money or market cap or what have you. So of course they're up there because they're big. Now we're using log scales here, yeah, and then going on this one, you can't double the amount of real estate in the world. You can't double the amount of gold. So they're big, but you can't reverse engineer that and just say, okay, well, anything that I make and just I'll have limited supply of it going forward, then and protect that, and that guarantees value creation. It doesn't. I think it's the asset that you have to look to for why the value is created. And in Bitcoin, the most important thing is demand, because there are two things that set the price. One is supply, one is demand. And the stock to flow thesis leaves out the entire demand thing, which is what I believe is the most important way to value Bitcoin. So to ignore the bit that statistically has the strongest link, to me is most strange. And to assume that if we just sit back and do nothing, because the stock to flow, whatever happens, will keep on rising, because that's in the code. So we can all sit back and do absolutely nothing, and somehow a huge amount of value will be created. I just don't see that as a useful argument at all. And I'd say that in the gold market, you have a very similar, because gold and Bitcoin, well, let's face it, were built along similar supply ideas, and so they're on that side of it, they're pretty similar. But people in the gold market do not talk about the gold supply very much. I'm not saying they don't talk about it, but it's not seen as an important factor. Yeah, and indeed, I polled the LBMA members on this some months ago, saying what happened if gold mining was banned. Other people have asked the question, what if those huge amounts of gold were discovered? And I think most people believe, well, not much. I don't think it's that important. Obviously, if you trebled the amount of gold above ground ready to market, that would be pretty devastating. But if you blew up Fort Knox, like Goldfinger wanted to do in the 1970s, I'm not sure how damaging that would be either. I'm not suggesting these things will do nothing, but this is not how you create value. The way you create value for gold is to have a big market and introduce it to more people and create demand and all the rest of it. And I think these supply side things are just sort of just sort of misleading, I would suppose. And there are various other arguments I've written about. For example, I just want to touch on this last one because there are lots and lots of points, and it's kind of not the most important subject we're talking about today. But the stock to flow at the beginning was really important, because on day one, the only Bitcoins were owned by miners, and on day 100 and day 1000, the miners were dominant in the space. Most Bitcoins were controlled by miners. The annual supply of Bitcoins was as much as the entire economy. But as we go forward, they become less and less relevant. So I put the numbers down in the document, but I think it's something like 2% of market cap is mined each year now. Is that right? Or was it or 2% of the network? 2% of the network is mined each year, and 6% of market cap is mined each year. So these are really small numbers. So how can the dominant influence? How can the idea that the reason there are the only people with Bitcoins will be the miners in 100 years' time, just before they switch it off, and because it's so hard to get Bitcoins, was assuming that no one else can sell them. So how can the miner be the price setter when they're not important members of the network? They're going to become less important each year, and yet the argument is that these guys drive price. They're less important each year. They're irrelevant eventually, and so I just don't see it.
Right, because there's more than just miners that hold the Bitcoin, right?
Yeah, I mean, they become less relevant rather than more relevant. I guess that's if you want to shorten the argument really, really quickly, that would be it.
So if we really shorten the definition of a hodler, what's a hodler to you then?
A hodler? Well, that's someone who just buys and holds the asset. That's what index funds do, isn't it? I mean, the index funds buy shares in companies, and that's it. So there's nothing wrong with that. But I think if everyone was a hodler, then Bitcoin would have no value.
Yeah, and taking that thought and maybe taking it one step forward, you did propose and describe an alternative model to value Bitcoin as opposed to stock to flow. Can you maybe elaborate a little bit on that one and walk us through the mind process that we have?
Yeah, I mean, there are a number of credible ways to value Bitcoin, and some of them are residual. Others are, I think, a bit more predictive. But basically, it's a real asset. And where is the value of the Bitcoin? It's in the network effect. So if it's a bit like, do you remember when the phone was invented? I'm not sure if you were around, but I wasn't. But can you imagine having the first telephone? Who do you call? Having the first telephone wasn't very useful. Having the first car before there was a road, or a train before a railway. None of these things were very useful. And you could say that about hydrogen power today. You can have a hydrogen car, but hard to fill it up. But these things change over time, and eventually there'll be plenty of places to do these things. And the network effect is precisely that. The more of it, the more an asset is around, the more a good is around, the easier it is for other people to adopt it. And so, Bitcoin's really got that. It's over the hurdle. It's over the initial step. And every year, more and more people talk about it, are interested in it, own it, trade it, use it. And so that is the value. It's the network. And, Bitcoin, for some people, it's just something they trade. For other people, it's some sort of libertarian evasion of the system. For some people, it's a technology. For others, it's a utility because they consume it and use it in various ways. It's many different things to many different people. And you bring all those things together, and there's a network effect. And so you just got to measure the size of the network. And there are many ways to do that. And statistically, the most accurate one I've found is to basically measure the amount of Bitcoin that is on the on-chain transaction over a period of time, and link it to market cap. And there's an R squared above 80, and I think when you're above 80, you're thinking, well, that'll do for me. And that chart's in the report, and you get a fair value from that. It identifies the bubbles, it identifies the times when the coin is cheap, and right now the premium is about 20%, which is fine. And the fair value is published, by the way, live on the ByteTree website.
Yes. So thinking about the so-called crypto winders in the past, what was the transaction values back then? How it kind of signaled what's to come?
In past downturns, you mean?
Yes.
Yeah, I mean, I'm not suggesting it's a leading indicator to the extent that the network value collapses ahead of price collapse. They kind of happen at a very similar time. But you do get a signal from excessive valuation. And for example, if you have using the ByteTree methodology, if you have a 5-week NVT above 10, it's very, very rare that the price goes up. I mean, the probability of a rise in price from that is extremely low. Yeah, and there's quite a few of these observations that we've discovered through number crunching, and they seem to stack up pretty well. So is it predictive? Well, high valuations are predictive of low returns, which is very different to suggesting you should short here. It's not the same thing. It's not the same thing. But it's a really bad entry point statistically, and that's really what we do. I think in finance that's really as good as it gets. You're looking for signals, and you're looking to say how reliable they are, and the most reliable signals you put more money behind them. The less reliable signals you put less money behind them. But we have ensemble strategies and so forth. We put all these different things together, and the outcomes are good. The outcomes are good because you're basically just trying to identify when there's a problem in Bitcoin. And if there's a problem in Bitcoin, then go and do something else, maybe even bonds.
Okay, so something to definitely pay attention to. One thing that was kind of insightful for me as well. I mean, I've been in this for a pretty long time, but still minor economics and how miners behave, truth be told, I never really got it because I never actually mined a single Bitcoin. But you do make some excellent points on give some great insight into how miners make their economic decision making, how their economics are governed, and you also introduced some of the concepts like first spend and so on. Can you maybe walk us through it a little bit more?
Yeah, and this was the an investigation some time ago when we were trying to understand what the coin supply was. I mean, the first thing is that the theoretical coin supply and the actual coin supply are really different. I mean, the recent halving was in May, right? Well, if you do 4 years since January 2nd or 3rd, 2009, and do 12 years since then, it should have been next January. So it was, that event happened sort of 7 months early, right? And that just shows you how eager the miners have been over the last 10 years in mining too quickly. So the average block time's been below 10 minutes. So therefore we've got ahead of ourselves and all the rest of it. So we're trying to look at that and trying to understand that, the importance of the average block time. And then it struck us that actually the miners could mine Bitcoins, but then just sit on them. Maybe they don't enter the network. So how would we measure that? And so we did. And my initial thought was, if we could identify, what the miners were doing, then, when they were sitting on their hands and not selling, then presumably the price would rise. But then to my shock, and this is what I love about data, is it sometimes tells you that you're absolutely wrong. And in this case, we were absolutely wrong. And it said the opposite. It said when the miners are sitting on their hands, that coincides with weak market periods. And the reason they're sitting on their hands is because the market's too weak for them to sell into. They don't want to damage the price. They know that if they start selling aggressively, the price is going to go down. So they don't. They stand back. And so actually, counterintuitively, when the miners are selling more aggressively, then that reflects a strong, healthy market. And statistically, that plays out. If you own Bitcoin when the miners are selling, then that kind of coincides with the periods when price is appreciating, and you miss some nasty periods. So one of the great advantages of data over narrative.
Right, but then again, there is this age-old wisdom that you always sell into strength. So apparently, miners make some pretty good investors and traders, no?
Yeah, well, I mean, the miners, these are people who have made a lot of money. I think I'm right in saying that the miners have created $20 billion worth of value in 10 years. About right, isn't it? I mean, it's huge, isn't it? Little Bitcoin, $20 billion from mining. That's big boy stuff. So, these people know what they're doing, and to assume they don't is ridiculous. And so you've got to assume that they've got a good process to manage their treasury positions, and the evidence is clear.
Sure, and you also developed a pretty novel concept to describe their treasury management, which you called miners rolling inventory, or even more sexy, MRI. Could you maybe kind of explain what an MRI is to our
Well, it measures that because, so what we've got is in first spend, the Bitcoin, the miners, generate all these coins each day, and they don't have to sell them. They can just leave them in their wallet. And if they leave them in their wallet, the inventory level builds. And if they spend them, then those coins are out there into the network. Now, it could be that when they send them or spend them or send them, they send them to an exchange and swap it for cash. I assume that's true in most cases because they've got very high costs, and a miner's in it for the cash. They're not in it for the hodl, generally speaking. Certainly the industrial scale miners, that's true. And so you know how many coins have been created. You know how many coins are out being distributed. The difference between them is the inventory. And essentially, when the inventory is rising, take caution, and when the inventory levels are falling or stable, then that's a good thing. So we're just picking up on the fact that when the miners are hoarding, that's just telling you, not definitely, because every data point has its issues. It could be they've sold too many already, and so they haven't got enough inventory to draw down. But generally speaking, provided they're selling their inventory at the rate they're creating it, then that's a sign of market health. It's more the case of when it builds up quickly, then that's really telling you there's a problem.
Yeah. And you spent 20 years looking at the gold markets, the oil markets. So how do Bitcoin miners compare to gold miners and oil producers in their kind of rationale?
Well, I think they're the same. They just want the money. They don't care about the gold, the oil, or the Bitcoin. They're in it for the money. It's a very different motivation. When you meet a miner and they tell you, they give you a bullish view on gold. So you go to a gold conference and you meet the CEO and he tells you about the outlook for gold. And you kind of wonder why, because everyone in the audience is bullish gold already. And so he doesn't need to say it. But you'll realize that a disproportionate amount of his presentation, when he's only got a 5-minute slot, will be on how great the gold market's going to be. When actually what he should be telling you is how much gold he can get out of the ground. And I say he, it's always a he. And that's kind of tells you that their motivation, they're trying to demonstrate that they actually care about gold, but they don't. It's very obvious to me that they're trying to um, get investors to care about their company, which is very different. So their motivation is not the same. That doesn't make them bad. I'm not making a point like that. It's just the assumption that they must love the asset they're mining. I don't think it's true.
So
I
the
think
key
there's
takeaway.
opportunity. Their goal.
So
Their goal is to get it out cheaper than they can sell it to you.
So the key takeaway, if you ever talk to a bullish Bitcoin miner, keep in mind that he's selling you his Bitcoin as you're buying it.
Correct.
Okay, and maybe now turning from infrastructure, mining, macro views, which is very data-driven, historical data-driven, and now we kind of venture into the final chapter of your report in our chat, and that's the unwritten future. The future is unwritten. There's a brave new world ahead of us, even for Bitcoin and crypto. Where do you see the opportunities, and what value and function do you see Bitcoin having going forward?
Well, the first thing is, I've got an extremely high conviction that this space is going to be bigger and better, in 5 years, 10 years, 20 years than it is today. And none of us really have a clear idea where it's going. And I hope I'm right in saying, and I didn't think this several years ago, but I do now. I believe that Bitcoin is at the heart of the space, and Bitcoin will continue to be at the heart of the space for a long time to come. So that's the point. If that's not true, then I think that the long-term, the non-crypto people, the long-term institutional investors should switch to crypto index funds. If that's not true, but right now it still appears to be true. So don't bother with the index fund, stick with the Bitcoin. I think that's the sort of simple advice to the non-Bitcoin people, to the non-community people. But where's it going? Well, did I see a tweet today saying a piece of art, crypto digital art, was auctioned at Christie's for $110,000? Did I hear that a piece of virtual real estate was transacted for $200,000? This is virtual real estate. This is you go to a website and you can buy a pretend piece of land. Yeah, this is not the real thing. This is like a cat, a crypto kitty. These things, you can laugh at them, and it's pretty hard not to at the beginning. But then you look at e-gaming, esports gaming, and see how big that is. And people went, well, why would you want to watch someone else play a computer game? And you say, well, ask the older generation why they want to watch someone else drive a car, someone else, fly a plane or drive a speedboat. Surely you want to drive a speedboat, drive a car. And so I think it's just a progression. We've started, you put people in cars who are really good at driving them, and then you put people doing esports, and now we've got worlds curating on the internet. And I think it's just a natural extension, and it's a symptom of where this is going. Now, I'm not suggesting that institutional investors buy virtual art or land, but I think that to understand the movement, some of the things that are happening, and other things are much more tangible, like the Brave browser, like what's happening at Binance, all these new chains, these new platforms for tokens, and then we've got the non-fungible coins. And so there's so many things that are coming. And I love the way that this space keeps on experimenting. And it doesn't really matter if something works or doesn't work, because it just keeps coming with the next idea. And every now and then they stick. And that's the excitement. So, what you're guaranteed in this space is 1 million young coders coming on each year and having a go at building something. And guess what? Every now and then someone does something brilliant. And that's the value creation in the future. I just don't see how this space can go away. I don't see how you can put it back in the box, and I don't see how it can fail. And the concept of transferring value over the internet seamlessly and efficiently and securely, why wouldn't you want that? Yes, I would say that there's a bit of a criticism that it's a solution looking for a problem. There's a bit of that, but isn't there always when it comes to the internet? I mean, certainly in the late 90s, when I first joined the stock market and watched really bad .com ideas being worth huge amounts of money, just like what's happening today in parts of crypto land. The society had invented the internet and didn't know what to do with it. It took a while to figure out what to do with it, but then now it's amazing. It's hard to explain to people of your generation, Miha, how bad the internet was in 1999, yet how high share prices were. And to put the two together, it was really, really terrible, yet people paid huge prices for this stuff. because there was a faith that it was going to be great in the future. And guess what? It was.
Well, Bitcoin was pretty terrible to use in the early days as well, and now it's pretty seamless, I would say. But
Yeah.
I do agree that we still have some way to go. And it's absolutely fascinating that it took 10 years to get this far. But do you see that it will take another 10 years for another big breakthrough, or do you see that time just halving every single time as we progress?
Oh, demand halving, you mean, as opposed to supply halving?
Not necessarily Bitcoin halving, but like in innovation. My personal view is that we'll probably see some big breakthrough in crypto land in 3 years as opposed to the next 10.
Yeah, there'll definitely be a halving in the number of skeptics, and there'll be a doubling in the number of institutional investors. And so I can see, huge progress there. And yes, I mean, go back to 2009, 10. I mean, most of us hadn't heard of Bitcoin. I wish I had heard of it, right? Because, I'd have probably bought some. But, there weren't many people working on it. But now there are so many people working on it, and so many things come through. And I've been watching this space for 7 years, and every day I hear about a new company that I've never heard of the previous day doing something. Yeah. And hopefully a lot of people out there will have heard of ByteTree for the first time. Yeah, we're not new, but
Well, I certainly hope that ByteTree will get some more exposure after this, hearing this fireside chat. So, Charlie, it's been an absolute pleasure to have you on our show. And I really hope that ByteTree does well, sees more traction, and that we'll be having some really cool reports coming out in partnerships with Bitstamp, obviously, in the future.
Well, thank you very much, and I wish Bitstamp the best as well.
Thank you. Good. Thank you all. I hope you enjoyed the show as much as I did. And please download and read this excellent report, co-authored by Charlie Morris at ByteTree.